Hey, this is Sasha. Thanks for joining me in today's video. What we're going to cover today is a little bit of adjusting credit spreads or managing credit spreads. This is a question from Justin. And if you have a specific question you want to submit one by voice. So that way it's more detailed and you can go ahead and get a video response kind of like this. We'll just schedule it as a regular episode. Anyways, thank you so much. If you have one, check out the website, tradersfly.com, submit a question by voice, or of course, check out some of the getting started pages there as well. So let's take a listen to the question and I'll give you my thoughts and insights.
Hi Sasha, this is Justin. I have a question regarding managing weekly options, specifically credit spreads on 12% probability of in the money and 9% returns on the weekly options. So my question is, when do you exit a trade if it's going bad? Do you use probability of in the money to exit a trade? For example, if it goes to 25% of probability of in the money or 30%, do you decide to exit then? Or do you use a fixed stop loss such as 50% of your max loss to decide when to exit your trade? And also, on the day of expiry of the options, when do you decide to wait for your credit spread to expire entirely out of the money or exiting the position earlier? Thank you in advance, Sasha.
All right. Hey, thanks, Justin. All right. So let me give you my thoughts and insights. First, let's go ahead and make sure we understand what's going on with the question. So if we take a look here at what's going on, Justin, what he's trying to do and what we're talking about is when we're talking about credit spreads. So let's say we're talking about an iron condor. Here's kind of our iron condor graph and picture. And this line slowly gets closer and closer to expiration. It could be just a vertical on one side or the other. So credit spread, you're collecting premium and you're trying to get theta decay. So these prices shift around and move around quite a bit. So you might be over here in this area, you might be over here in this area. So the big question, I guess he's asking is, when do I exit? When do I take profits? When do I take losses? How do I go ahead and manage these things, right? Because as you get closer and closer, you got time decay. So now the probabilities as we continue to head here, okay, initially as you're starting it out, you might start out with, let's say, a 90% chance of success. Or when you're looking at it, it could be a 10% of in the money. So it's basically, you know, it's the same thing, right? 90% chance of success or 10% in the money if you were the buyer. So when I look at this, as this starts to head closer and closer, this now could be more around the 20% or even 30% in this. And now you start to go ahead and actually it'd be the other way. 20% and 30%. And now this starts to become, the odds are less in your favor. So now you're looking at, 80% and 70%. So when we look at this on a platform, what's really happening is that your probabilities are really going down. Your chance of success is going down as you get closer to one of these edges, right? So do we go ahead and manage our position based on probabilities, or do we manage it based on a dollar? So dollar meaning, hey, if you're looking to make $500 on the spread, and then you also have probabilities, so you start it maybe at 10% and now the position went into a 30%, do you take the position off? Or you're trying to make 500 and now you're down, let's say 300. Well, the reality is you look at kind of both. And when I look at this kind of position, we start looking at some of these things, what's going on, what's happening. I don't think I have any credit spreads on right at this moment, with the exception of maybe the Russell here, but that's more like a butterfly. But ultimately, what you're doing, and when we're looking at this, so let's say we start a position on Tesla and we're looking at, it doesn't matter whether it's weekly or monthly. We're talking about, he was asking about weekly. So we'll go into the weekly. So let's say we were doing 16 days or so, or shorter term duration. So what we're ultimately looking at is this probability of in the money. So if I'm a net, let's say, seller of this, and I sell it at around this 10% level, okay, that also means I have a 90% chance of kind of success. So if I'm selling at the 10%, that means I got about a 90% chance of success, because 10% is the 10% if you're a buyer of it. So, if you're buying at 420, the puts, you only got about a 10% chance of success. Whereas if you're selling, well, you got the opposite of that. So that's 90% chance of success. So let's say we go ahead and this then later converts or becomes a 20%. That's a lot closer to the current price. Or it becomes a 30%. Now you're at the 485. and it continues, and then you're getting closer to the money at the 540. So when we look at Tesla right now, that stock price is 536. That's high, huge, right? It skyrocketed quite a lot. And it's an interesting stock to play with a lot of this volatility. So when you look at this kind of thing, what you can do is you can go ahead and set up your position. And I'll say, okay, well, let's start out with selling an iron condor, or let's just say vertical. Keep things simple. Looking at a vertical 430 and 415. And here's kind of our credit spread, okay, that we're trying to set up. There we go. So let's say we start out this position. I'll go ahead and maybe we'll put this one in even. So you'll go ahead and you'll start this position off. We got one contract or two or three, it doesn't matter. The probabilities don't change the number based on the number of contracts you're doing because it's just stacking more cash and capital. But here, I'm looking to make about $645 here, $645, $650, based on the amount of risk of 6,850. So, you know, a little under 10%, about 9%. And when you're looking at this, I start this position off because it's really safe, right? The current price, as I look at this in Tesla, I mean, continues to skyrocket, right? But it's around 535. And as I put this position on, here is our price and here is our strike. So that range that it has to move is quite a lot. So even though I go ahead and let's go ahead, confirm and send this in, put this position on. And now when we have that position, you can see I'm at the 12% range, which means I have about a 88% chance of success. And then the protection is at 9%. So when I put this on, and if this starts to go against me now, and it becomes, let's say, 20%, then yeah, absolutely, you could go ahead and define it based on the probabilities and percentages. But you got to also recognize your capital, okay? So if you're always making, let's say, 600, 600, 600 on a position, and you're doing it month after month or week after week, well, you probably don't want to lose more than 800 or so on any single trade. So even though if this, let's say, starts heading against me, and it starts going down very quickly, and I'm down about $913. And why is it a little more than the 650? Well, because I want the probabilities, I want to give them a little bit of time and room to move. So that's why I allow the dollar value a little bit more than the actual profit I would make, because if it comes down here and then it snaps back, then we're fine. The position's fine, and you got the theta that continues to work in your favor. But if it comes here, and even though the probabilities may still look okay, I would still take the position off because I'm kind of hitting my max loss. Otherwise, you kind of would want to watch for probabilities as well, is you combine it. If you're a person that's looking at probabilities and chance of success and you're not worried about your day-to-day fluctuations, then in that case, yeah, you make your decision based on probabilities. But I typically look at, hey, I want it to be under a 30% for sure. From my personal standpoint, typically 20 if you're a little more conservative during holidays or that kind of thing, just because you're maybe a little less focused. And then what you're doing is you're just managing your dollar amount. So as long as you're under 20, well, now if you're also above your, let's say, negative 700-800, then you're fine. And with time, as you know, those probabilities shift more and more in your favor because the theta continues to help you. And time, as that expires, the probabilities swing in your favor just because there's less time left in the position. So I would definitely kind of do both in order to look at the overall total position. I'd say a 30 is my hard get out of the position. And, when you're at 30, with 16 days to go, you're at 482, and the current price is 533. A 20 is kind of where I would look to maybe do some adjustments or maybe get out if something just doesn't look right. But you can see that I would combine that with a dollar value as well, because if I'm only making 650, I don't really want to lose, let's say, 2,800, even if things somewhat look okay or something like that. Let's say volatility picks up and this position goes against me. So I don't want to lose 2,000 dollars on it, maybe 3 or 4 times my amount of profits, even if the probabilities were in my range. So that's why I have kind of 2 variables that I would look at to set up and use them as a balance. So if that hits, fine, take your profits or losses. If that hits, also fine. Use those as kind of stop trigger points in both scenarios, in both situations, because that way if one fails, if one kind of sneaks by you, then at least you have the dollar value. If the percentages sneak by you, then you have the dollar value. If the dollar value sneaks by you, then you have the percentages. So use them as both, kind of like a redundancy thing to double check yourself. So anyways, that's my personal thought and take right now. You can see this is actually moving a little bit against us. You know, we got 5 contracts on there. You could go ahead and sometimes skew just as a quick kind of protection idea and insight. Let's say we go ahead and go to the 650 here, sell some verticals. So that way if things do sell off, here's some thoughts for you guys. Here's what I'm looking to do just to kind of balance things out, because the market is at all-time highs as I put this on. We'll go ahead and kind of do a couple contracts right here. Let's just do 5, even more skewed to the bearish side, just because we've got volatility that'll work against us as we move to the downside. So I'll kind of skew it that way. And now I got 2 credit spreads right there, one on the left, one on the right. And working on the theta, about 83 a day, looking to make about 1,400 from this position across $6,075. So anyways, that's kind of a basic trade idea for you. Don't forget to hit subscribe on the YouTube channel. Thank you so much for joining us. Here's the subscribe button right here, or submit your own question by clicking the link over here, or join us on the newsletter list. So that way you get notified as we release other great classes, videos, insights, books, and more great stuff. Thank you so much for joining me. Remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.